Hey, everybody, welcome back to another edition of Market Talks with Dr. Stoxx. This is Dr. Tom Carr, aka Dr. Stoxx of drstoxx.com, your one stop shop for all things trading. Go to DRSTOXX if you want to join me and an amazing group of traders of all different skill levels. We gather together in a Discord room. I share with them what I'm trading, my ticker symbol, entry price, stop price, target price, keep track of every trade. We do some trader training most afternoons on the live mic, which is what we're doing right now. And we help each other out with pointing to things that are moving in the market. It's just a great place to hang out during the trading day, especially when the market's been like it has been, really crazy. And it's nice to know that we're not alone when we're trying to make sense of this crazy market. So if you want to join us, go over to drstoxx.com. That's drstoxx.com. Click on the subscribe menu, scroll down to live trading room. And if you want to add on our new live options room, you can do that at a discount. Okay, so let's look at some charts. Now, let's focus on the major indexes. And you can see, let's get rid of some of the noise here. We'll get rid of the divergence indicator, which is a good tool to have on your chart, but sometimes you just need some basic stuff. Now, I don't have my LRC on here. Why? Every time sorry, let me put back on the linear regression channel. And for those of you who are new, this is a good opportunity to learn how we do that. So we put on the channel twice, and then we scroll down into the settings, and we just change one of them to a 1.5 standard deviation, and on both sides. And when you do that, you're going to have a nice little pink band down below. Here's your midline and a blue band up on top. So the darker colored bands here in the linear regression channel, this is with the 100 default period look back. The darker bands here are the 1.5 standard deviation away from the middle of the trend. So somehow the software determines where the low pivot points are and where the high pivot points are. And of course, if the highs are getting lower, the lows are getting lower, then it's going to be in a downtrend, and vice versa for an uptrend. And then you get the pink band down here below. That's the 2.0 standard deviation, and the light powder blue up on top, the 2.0 standard deviation on the upside. That's away from the midline. And we expect moves back to the midline from below and moves back into the midline from above. And our mantra is that we buy the pink in an uptrend, not a downtrend, in an uptrend. We sell the blue in a downtrend, and vice versa for longs and shorts. So that's the general principle. Of course, the linear channel, like all technical indicators, is simply a tool that can be used and disused as you see fit. So sometimes there are other important reasons to go long when the linear channel itself might suggest otherwise. And we're kind of at one of those times, right? We're in a definite downtrend. And in fact, on the low print basis, we did hit some bear market territory, especially in the NASDAQ. Now, here's a point that I wanted to make. So 20% off of the most recent 52-week high. 20% below that is the standard definition, textbook definition of a bear market. That's not the beginning of the bear market, however. And in a lot of cases, it's pretty close to the end of the bear market when you hit that 20% level. Now, of course, they can go a lot further than that. The 2007, 2008, 2009 bear market went down over 55%. The COVID bear market went down 25%, or more. I'm not exactly sure how far down the COVID bear market went. 2022 bear market got to 30%. So it can go further than 20. But the point I'm making here is that the bear market didn't begin at 20% below the high. The bear market began at the high, right up here. So we can now say if we are indeed 20% below, and I don't think that's true yet for the SPY, but I think it was true yesterday for the NASDAQ. The bear market started here back in February. So we've been in a bear market now, we can say, at least for the NASDAQ. We've been in a bear market, certainly for the Russell 2000 for the better part of 2 months, right? Month and a half already. How long do bear markets last? Well, the bad news is they tend to last a little bit longer than that. I think around 15 months is average length of time for a bear market. I could be wrong. I'm just pulling that number off the top of my head. Bull markets last much longer, thankfully. So really about a 3-to-1 ratio. It's about a 3 to 4 year term for most bull markets before you get a significant correction. And I don't think we got there. We didn't quite get there from the 2023 bear market bottom. We didn't get 3 years at least. No, we're still working on that. So anyway, let's talk about what's going on in this particular market. So we are down. Let me get our index lists over here. And the market's kind of trying to find a bottom. So yesterday, gapped way down. And if the pre-market price action was really, really low, got all the way down to 48.30 on the S&P 500. That's actually not the SPX. That's the micro E-mini for the S&P 500, which is a little bit, the calibration of the numbers are a little bit different. So it was really about 1821. I'm sorry, 48.18, I think, was the low for the SPX yesterday, something like that. 48.21, I think, was the low for the official S&P 500 index. So 4,800, there is a lot of support there. There's support at 5,000. There's support at 5,200. And there's support, or I should say former support, now resistance, at 5,400. So once you get below, this is a standard technical analysis reading. Once you get below what used to be support, it becomes resistance. And that's what we're seeing yesterday and today. So 5,200. Right here, that black line, you can see how significant it was. It caught several dips back in August of last year and provided a floor that propelled price quite a bit higher. And prior to that, not exactly 5,200, but pretty close. It did provide a ceiling, and then again a floor, and again a floor. And now that we are below it, it's going to be a ceiling all over again. So 5,200, let's move this out a little bit further. 5,200 is going to act as a bit of a stop there. And we got to almost 5,300 today. Again, this is MES, it's not SPX, so the numbers are going to be a little bit different, but I like to use the MES as my gauge. We got to 5,304 today, right in the middle of this. Right in the middle of this. Boy, I'm sorry. We're having storms outside, and we've had some trouble with our internet kind of going in and out. So I think we'll do the best with what we can. Hopefully, I don't get disconnected. Okay. So got up to 5,300, and let me show you what was going on in the 2-hour chart, because this is not looking so good right now. This is a chart that we use to determine when we are starting to see after a long pullback like this, starting to see some bullish things happening. We did get a little bit of that. Hang on a minute here, because this is not. No. Maybe it was the 1-hour chart. Yeah, I guess it was a 1-hour chart I was looking at earlier. Okay, so we had the bullish crossover of the 21 EMA over the 50 period moving average, and the 21 had been starting to rise higher consistently for several hours, both at the end of yesterday's trading, overnight, and early this morning. We hit the top of the linear regression channel 2.0 standard deviation. And if we go to the 2-hour chart, we're going to see, I think this is the right read. Right. We hit the 50 period moving average also on the 2-hour chart. And that was really about all the market could take. So here's what we're looking for. I've said this so many times. Those of you who've been in the room for a while know this by heart. Typically, a long pullback is going to give you long swooshes down, right? That are pretty steep and nasty and scary. Short-term bounces, relief rallies, we'll call them, not really dead cat bounces, but relief rallies, followed by longer and scarier legs lower. We've seen several of these on the way down, right? It took a little while for this bear market to get going, but once it did, and then especially after Liberation Day, when everything cracked to the downside, we haven't recovered yet from that. And it's a week on now. We're almost up to a week after Liberation Day. Here's what we're looking for. We can start to see this on the hourly chart, the 2-hour chart, and then eventually the daily chart. We're looking for a bounce off the most recent low pivot, a rollover, which is what we're getting right now on the 1-hour and 2-hour charts, that then prints a higher low. We need that higher low. What I mean by higher low, here's the low pivot that we're looking to print now on this current move, 1-hour, 2-hour chart, that is higher than the most recent low pivot that's the lowest low off of the 52-week high, right? That was yesterday. Yesterday on an intraday basis printed that lowest low. We need to see a higher low. Are we out of the woods yet at that point? No, we're not. We're not out of the woods until the most recent high pivot, which is that one right there, gets taken out to, the upside. So that's what we're looking for. We're looking for this move to get going, and we're not there yet. So here's what's going on in the hourly chart. Here's your low pivot right down here, and it's a nice rounded bottom pivot. General rule, technical analysis, rounded bottoms. We used to call that the J-Lo bottom. I don't know, the Kim Kardashian bottom. Nice rounded bottom, followed by a pivot high, right? A pivot high, we got that already. We got that this morning. Followed by a higher low. Now, the higher that higher low, the better. So we don't want this to go too far down. And then we're not out of the woods just yet. Then we need to see that pivot high from this morning get taken out. Now, if we just get sort of standard price action that isn't too conflicted with what's going on in the news cycle, which is we're totally trapped by the news cycle right now. Every single headline, I'm scrolling through Twitter when I'm not looking at the charts, when I'm not actually trading, when I'm not talking to people in the live room, I'm scrolling through Twitter watching for headlines, right? Got to keep up on the headlines because that's what's moving the market. So if we can get if we get a little bit of a lull in the headlines, if we can get President Trump to come out and give us a little bit of hope that there's some negotiations going on, especially with China, EU, European Union, Canada and Mexico, those are kind of the four biggies, right? Those four groups make up probably 60% of our trading revenue. So if we can get negotiations, backpedaling, softening, delaying in those groups, then we can see a really nice rally going, but we're not there yet. So we want to see a higher low. We want to see a higher low, and then we want to see a breakout above the high that was printed this morning. We're not there yet, but we're still trying to form that higher low. So it's certainly within the realm of possibility. And I'll tell you what, I've been talking to my cycles guy. This is a cycles indicator down here, by the way. So when you drill down into the hourly charts or below, the cycles start to lose their traction, their ability to give good sound predictions. But when you look at the cycles on a daily chart, it's pretty uncanny the way that these are cycles of long-term cycles, short-term cycles. They're all set at different Fibonacci ratios. And the theory is that when these cycles line up, you tend to get, when they line up at the highs, like this group right in here, right? When they line up at the highs, you tend to get a rollover from the top. When they line up at the lows, you tend to get a rollover from below. And I've been talking to the guy that does this, and that's all he uses for trading. And I've shared this in the room several times, but he's looking at a reversal to the upside for about 2 weeks, starting Thursday, Friday of this week. So we're not there yet. And then I've been talking to my guy that does, I'm in a pro trading group. All of us are guys who trade for a living, and we share ideas, bounce ideas off of each other. We're all coming at the market from different perspectives. And there's a guy who does Elliott Wave. I'm not a big fan of Elliott Wave, I have to say. Seems a little too subjective to me, but he makes a living from Elliott Wave, and his theory is that we are very close to the fifth wave down. Then, Elliott Wave, if you know the theory, you in a pullback, you get 3 waves down, 2 waves up, little relief rallies. These little relief rallies. The third wave down tends to be the sharpest. You get a little bit of a relief rally and then back down again. He thinks we're at we're nearing the end of wave 5, which is a little bit of a different perspective than he had last week. Last week, he said we were still in wave 3. Now he's saying we're in wave 5. So, hey, I'll take wave 5. It's better because wave 5 tends to end that downtrend, and then you get a 3-wave corrective phase going higher. He thinks that this is where we're heading over the next couple of weeks, and then maybe late April we get a little bit of a pullback, and then we get another C wave going higher, and then all bets are off after that. But that's his map. So if Elliott Wave is okay, if cycles are okay, we should have a bounce. But even if we go past all of that and we start looking at, let's take a look at the fear and greed index. And I owe the fear and greed index a fair amount of the profits that I made after the 2018 serious market correction. It wasn't quite a bear market, but the market was down for a long time, and it really was not very good in the end of the year. And it bottomed out on December 24th. I'll never forget, because I went very, very, very heavy long, 24th, 26th through New Year's Eve, and held on for about 3 months and made really, really nice money. And here's the thing, the fear and greed index at that bottom did not get this low. It was a 7. 7 was the lowest that I remember seeing. It did get down into single digits, but not a 5 in the 2022 bear market. And I don't remember, in fact, I'm not even sure there was a fear and greed index during the 2007, 2008, and certainly not during the dot-com bubble burst. So I don't know what those numbers might have been, but it got to a 3. It got to a 3 yesterday off the open. I have never seen anything that low, ever. So this is it's an interesting mix of ingredients. So you've got price momentum to the downside. You've got new highs and new lows on the New York Stock Exchange. You've got McClellan summation index. You've got put and call options, right? The put call ratio, and you've got the VIX. And you've got bonds, right? So you throw all that in there. Oh, and junk bonds. You throw all that in there, and you crunch out a number. And when it's down in the single digits, you know that that's just at an extreme. If we go over to, let's take a quick look here at some other ways of looking at market fear. We go to stockcharts.com. We go to market summary. We scroll down. And you're going to find some interesting things down here. So here we go. So we've got the VIX. It's up near 50, which is extremely high. It's 60 yesterday. It's been up to 50 twice today, and I suspect that's about it for VIX. The put call ratio. Look at this, 1.2. Now this is not a live feed. This is the end of day yesterday, so it could be a little bit softer now. But when it gets up to 1.2. It just almost never gets up that high without almost immediately, I have to use a lot of almost in there because we're in kind of a strange market environment right now. When you get up to 1.2, you are almost always at the maximum level of fear that you're going to see in the market. And that should start to alleviate. We should start to realize that, probably the worst case scenario, now that we know it, now that we know the worst case scenario, because we didn't even know it till Wednesday after the market closed. Now that we know it, the market still has probably overreacted, at least for the short term, until we can figure out better what's going on with these negotiations. McClellan Summation Index is down way, way, way below levels where typically you start to get market bounces, right? Negative 400. You get to make negative 400, like this one right here in January, you tend to get some nice market moves to the upside. We're more than double that, okay? We just have to be very, very close to a major market bottom. And by major, I mean the kind that can really make some very nice returns for all of us. Bullish percent indexes, you want to keep an eye on these sectors. Typically, when you get, mark this down, when you get bullish percent indexes under 30%, first of all, that doesn't happen very often. And when it does, it tends to mark a market bottom. Look at these numbers. I typically look at this when we're in a market correction like this, and I don't think I've ever seen, with the one or two exceptions, ever seen a major market index like the S&P 100 and the NASDAQ 100. I've never seen them in single digits. Never. This is the point and figure chart, right? So if we look at a typical point and figure chart. And how do we get there? Let's, where is it? Is it in here? I'm not seeing it, but maybe you, okay. No. Okay, never mind. Anyway, there's a way you can get a point and figure chart showing up in stock charts. But let me just go back to this point here. Anytime you get under 30, and every single one of these, except for the Toronto index, we're not trading that anyway. Every single one of the major sectors in American Stock Exchange, with the mining sector is definitely the strongest. 75, that's very bullish. You get it under 30, and that tends to be, look at all these single digits, crazy. The banks, the healthcare, infotech, right? Your Googles and others. Your industrials, your materials, way, way, way down here, single digits. Just crazy. Let me just show you what I mean. So here is a chart of the NASDAQ. What does this mean? There are 100 stocks in the NASDAQ 100. This means that only 6 of those, and are there any gold mining stocks in the NASDAQ 100? Maybe there is 1 or 2. There are only 6 stocks out of 100 that are showing a bullish percent on a column of X's, right? X's means the price is still moving higher, or at least it's not moving lower. When it's a column of O's, that means the prices are moving lower and lower, right? It's kind of a very neat way of charting price movement. So each X or O stands for X number of handles in a stock price. Typically 3 or 4 or 5, depends on how high the price is. And every time you get into a new box of 3, let's say it's just 3 handles, every time you get into a new box, you get a new X on top of the old X. When it goes down 3, then you go to a new column, and instead of an X, you put in an O. And you keep adding O's in the same column until you get a rise in of 3 handles, then it goes back to X's again. So your price is always going to be in X's or O's. If it's in O's, it's a bearish read, and if it's X's, it's bullish. Very simple. Only 6 are on a bullish. Let's go back. Let's go back and see. Can we go back 10 years? Maybe not. They won't let me do that. Okay. How far back can we go? Actually, let's do the weekly. That'll get us back better. And how far back can we go with the weekly? 5? Yeah, there we go. Okay, so at the bottom of the bear market, it looks like it's about a 7, right? 7 back in the 2022 bear market. We're at a 6. We are below that. We are worse than the 2022 bear market. I'm sure if we went back and, is that the COVID? No, COVID lows. Where are the COVID lows? Yeah, okay, never mind. Anyway, if you are a Stock Charts member, you can let us know. Has there ever been a reading as low as 6 in the bullish percents for the NASDAQ 100? I'm curious to know. If you are a member, let us know in the main room. Okay, back to charts. So all of those are reasons why we should be near my cycles guy, my Elliott wave guy, bullish percents, put call ratio, AAII.com, fear and greed index. They're all flashing major extreme levels of bearishness and fear, market fear. Okay, well, for very good reason, right? Because these tariffs, we don't know exactly we don't know how long they're going to be in place. We don't know whether a country like China is going to start negotiating with us. They have given us no signal yet that they're going to do that. And we don't really know how badly they will affect the economy in a bad way, but how bad will it be? We don't really know. Now, here's some good things. So if we look at recent GDP, if we look at inflation coming down, oil is really coming down. If we look at the job market, there's a lot of fear about the job market, but we look at the actual numbers, it's not there. Jobless claims aren't going higher. New jobs created still pretty good. The unemployment rate ticked up 0.1%, but that's pretty minimal, still low. And the Fed seems ready, or at least we expect the Fed to start cutting rates very soon, as early as next month. So with the Fed providing wind at our backs, and with the overall economy is still pretty good, right? People are still making money. They're not racking up all kinds of debt. Then we may pull out of this much sooner than we think. However, I think what's going to happen is that we're going to get, let me go back to the daily chart here, because I'll tell you what my map is for the next few weeks. Let's get rid of all these lines. Okay, so we still have an hour plus of trading. We still could get a little bit more of some upside. We're going to show right now a fairly light bearish move on the market, but I do think that we're going to get a day or two more of transition, consolidation, choppy trading, and then we're going to get a relief rally that will probably take us. The 21 period average, I think, is just going to keep falling, and we'll cross it pretty quickly. But I think we probably could get up to the 50 by the latter part of April. Third week of April. At that point, we start getting all the big earnings, right? All the big mags start reporting their earnings. And if the tariff situation has not changed, that's going to be a problem. And I think the earnings are going to trigger a new leg lower if things have not changed. So I am looking for either a double bottom down to 48 again, or worst case scenario, tariffs aren't resolved. We could be down to 4,000. I don't think it's going to go any lower than that, but 4,000 SPX by summer. Okay, so we don't want to see that. We really don't. I mean, we can handle a 4,800 print again because we just had one yesterday. We had one yesterday, and we recovered. We're okay. We're still trading. We still have capital in the bank. We still have our powder dry, right? Although I've made some bad moves myself. I tend to get into things too early and out of things too early. That's just been my Achilles heel as a trader. I tend to have the right read on things, but holding on to winners has been a struggle. So, especially when markets are so volatile like this, it's just, your nerves are always a little bit frayed anyway. And anyway, we'll see. We'll see where things go. But that's my map, right? So, a couple of days of transition. Thursday, Friday of this week, we should be starting to see some consistent moves higher, taking out some intraday highs, getting back up above that 5,200 level. That's got to be the first floor. Don't think we're going to get back up above. Well, we could, I guess. 5,400 is right here. It's this line. What does this line work out to, right? Yeah, just call it 54.75. So somewhere around 5,400, I think, is about where we're going to go on this relief rally. And then we'll tag the 50, we'll kiss it and say goodbye for a few more days or weeks as we roll back over toward the end of the month. Then that could go on into, if we hit 4,800, I think we'll get there by early May. If it's lower than that, it could go on into June, July. Don't want to see that happen, but it is what it is. As I always say, we trade the market we're given, not the market we want. So the NASDAQ, there are some key numbers here. It's looking a little bit better today than, certainly than the Russell. I'm not even going to look at the Russell too depressing to look at the Russell right now. So here's the line, right? This line right here, which was a pivot low. And if we scroll back further, it was a bunch of highs back in March of 24 last year. That's a very key level. It's like around 18,000, 18,300. We tagged it. We tagged it yesterday and pulled back. We tagged it today and we pulled back. So clearly that's the line that needs to get broken. And unfortunately, we're back below this one right here, which is another pivot, a cluster of pivot lows. It was a little bit of resistance. There's a whole lot of traffic at that level too. And that's right around 17.8. We need to get back up above that first. A close of over there today, as I thought we might get, would be very, very constructive, but I don't think it's coming. We're not going to see consistent upside for a couple more days, pretty sure. So small caps, I know I'm long actually a little bit of the M2K because we had a trade on and we got stopped out of TNA, but I'm holding on to the M2K just again on all the oversold readings. My best returns as a trader have always come in market conditions like this, not in the conditions, because getting down there is just really painful. But once they settle and we start to see some consistent higher lows, higher lows, higher lows, breaking of resistance, when that starts trending higher, that's when making money can get very exciting because everything is so oversold and so undervalued now relative to where the economy is that the bounce backs can be very, very sharp and very profitable. All right, let's look at a few mags. Not really a whole lot going on here, but let's look at the worst to best. Apple is down. It had some bad news again. It was a big gap and crap. Tesla, to me, is a no-go zone. It's actually not as bad as some of the mags. It has been holding some of its recent lows. It's not, the last month has not been downtrending. That's a positive. And it wouldn't take too much for it to break out of this pullback, right? This is the pullback right here. It keeps tagging it. Keeps getting close, and then it just keeps recoiling because it's not ready to go. Yeah, there's some headwinds with Tesla, and who knows how the tariffs are going to play out with Tesla. But from a chart perspective, it's got some good potential. It's just not ready yet. We've got Qualcomm, which broke through the 150. Unfortunately, because it's like everything else, every floor for the major mags, except for Netflix, have all given way, and now we're trading well below those. But Qualcomm, again, Qualcomm is going to be a very good space to be in once we get past all the negativity that we're seeing right now. I don't think I would play Amazon. It got some good traction, and then I don't know. There's just I don't have a good read, I guess, or a good feeling for the story for Amazon right now. So to me, it's an avoid. I really liked Cisco for a while. It was really doing very nicely when everything was cracking down, falling hard, and then it finally fell out of this, what turned out to be a bear flag. I thought it was a bullish base. It turned out to be a bear flag. We never traded Cisco, but it just kept looking at it as a good looking chart, and then it gave way. Google still, you can see everything is really downtrending. We're down in the pink zone, which typically where you do see a bounce start to materialize, but not today. Facebook is still in somewhat of an uptrend. We are below the 2.0 standard deviation, and when you're uptrending LRC and you're below that 2.0, you only get about 5% of trading time outside of the LRC, so 95% of the time it's inside. we can expect to move back inside very, very soon. Today looked like the day for that, but unfortunately, no. Microsoft. Here's the interesting thing about Microsoft, and I've been pointing this out in the room. Somebody with very deep pockets is buying like crazy the 5 strike with a lot of time MSFU, which is the leveraged version of Microsoft. And whoever that person is, they just keep hitting the same strike, the same expiration. 1 million, 2 million, 3 million. I mean, these are huge orders. So I assume it is a fund. And the fact that they're going after the leveraged version is like they're not even worried about risk at this point. So I don't know how many, because it was not just today, it started on Friday last week. Someone has got probably $20 million invested in this thing. And, a hedge fund can do that, of course. But more likely, it is a private trader that just has some inside information about Microsoft. So keep an eye on Microsoft. I think it might have a good run, maybe one of the better ones after we get through all the negativity. We do have some NVDA on. It's NVIDIA. And if you look at the longer term weekly chart, you're going to see something that doesn't look too bad, right? Weekly charts are for most of the mags are in pretty good uptrend still. But if you go back and you look at the level that we were at the close yesterday, unfortunately, we're below that right now. But here, resistance, support, support. It has cracked, right? It cracked yesterday when it opened below that level, but it's rallied back up and we're now above. So watch the 100 level. Once we get back up above the 100 level for NVIDIA, and we were there this morning, it should start to get a good rally going. Netflix is your strongest mag. If you look at the weekly chart, it's just a beauty, a thing of beauty, right? This is classic pullback action in a nice looking uptrend. You've got the 21 above the 50. You've got the 50 above the 200, which I don't have on the chart, but it's down below. You've got the uptrending LRC. You've got the reversal in the pink zone. We tried to get above it this week. I guess that was probably yesterday's highs and today's highs. They're both about the same for most of these big stocks and couldn't quite get there. But you know what? Here's my ceiling, right? The more you punch up against the ceiling, every time you do that, you are erasing some of the supply of shares up there. That's why there is a ceiling, because everybody's got their sell orders up there. These are longs that are trapped underwater. They're shorts with their stop prices. They're people with buy stop orders because they realize once it gets up above that level, they can go. But these are sell orders for the most part. And once you keep getting up above there and triggering those sell orders, you have fewer and fewer sell orders lining that level, and then the breakout can come. So every time you get up there and test it, it's a good thing, even if it doesn't go through. Avgo is, yeah, on a weekly chart, not too bad, but on a daily chart, it's down like every other semiconductor. I do think Avgo's got a lot of good upside. In fact, let's take a look at the daily chart here. So what the nice thing about Avgo is on a daily chart basis, the LRC is pretty flat. It's not in a downtrend. It's not in an uptrend. Flat LRCs, like a trading range, you can sell short up at the blue zone and you can buy in the pink zone. And we had a very nice pink zone buy signal yesterday. Bullish engulfing candle, right? The range yesterday was bigger than the day before, that Friday capitulation day. Big volume coming in as well. Big gap up. Didn't hold the gap. Nothing is holding the gap today, but it is up still green. And yeah, this is about as good as you're going to get on as far as a buy signal in play in a major stock. Now, I want to show you the last thing before we go, and I'm afraid we're running out of time, so I do have to jump back into the live room. I won't be able to take chart requests today, but I did want to show you some interesting charts on the greens list. And this is a list of charts. Let's go best to worst this time. A list of charts that are not horrible. Given all that's going on in the market, these are not horrible. So I'm going to assume that most of these are like a tariff-free kind of thing, right? They're not as afflicted by tariffs as some of the others. Now, app is a software play, and we actually have a covered call on in this one in the options room. And it's a little bit of a downtrend, I have to admit, but that big reversal on big volume yesterday and a gap up today kind of brought us into the trade. We'll see where that one goes. But that is a big moving stock, and that has a lot of good upside potential. Look at this uptrend for OKTA, which is a cybersecurity software play, and it's reversing off of what is a former trend line. Not exactly sure I've got that in the right place, but that's a little, that's where it should be. It got close to that trend line, reversed yesterday, gap and crap today like everything else, but at least it's still up. And look at that LRC. The 21 is above the 50, 50 is above the 200, stacked MAs. Not a bad look given the market. Netflix, as I said, very nice looking chart, still uptrending, best looking mag out there. Hack is your cybersecurity ETF. So if you wanted to grab that whole sector, you would go with Hack. PLTR uptrend, big reversal stick yesterday on massive volume, and it really, really looked great yesterday. And I know a lot of guys in my pro trading group were out buying shares yesterday at PLTR. Tag the 21, and it's been a deadlock. Okay, now listen. Today, transition day. Tomorrow, transition day. First sign of good, healthy, bullish action, I don't think will come until Thursday, maybe Friday. If we don't get it by Friday, we've got CPI on Thursday, PPI on Friday. If we don't get a positive bullish response by then, oh boy, I don't know. We may be in some real trouble. We may be in, I don't know. We'll just have to see. But anyway, the miners. This is your strongest sector, your best stocks in terms of market surge, IBD metrics are all in the mining sector. You're going to find 99s all across the board there. A bunch of good stocks. It did have a gap and crap today like everything else. Everything else, gap and crap. But this is a nice looking, in fact, I think right now is a pretty good time to enter. We've got GDXU on in this live trading room. AON is from the IBD leaderboard, and it had a couple of bad days, started to recover today. Not quite there yet, but let's keep an eye on this. Down in the pink zone of an uptrend. And there aren't too many stocks that look like that. EXLS is another IBD leaderboard stock. CPRX had a beautiful hold of the 21 period last week. When everything was falling, CPRX was holding up quite nicely. The very next day, it tagged the 50 and held. And then, like everything else, gravity happened. But we got down into the pink zone of an uptrending LRC, and the MAs are stacked. And again, you're not going to find any perfect setup out there, but there are some that are pretty darn good, and this is one of them. CLS. So we went long CLS this morning off of a reversal bar, slightly uptrending LRC, big bearish, bullish engulfing candle on big volume yesterday, and it was starting to hold quite nicely off the open. And then everything just kind of came back in again. So I'm not sure if we're still long CLS. We might still be above our stop, but it is it's also good, right? This is a high-ranking IBD metric company with lots of good growth. It's a fast mover, but it's a slightly uptrending LRC, and we're down in the pink zone. Buy the pink in an uptrend, sell the blue in a downtrend. One last thing, AFRM. Got all kinds of huge call volume end of last week, yesterday, and again today. And we're talking about millions of dollars being spent on calls for a firm. So these are calls with time. So going out to December, going out to March next year, going out to June next year, right? These are leaps. So if you've got some patience, you might keep an eye on a firm. All right, guys, I'm going to let you go. God bless everybody. See you back in the main room in just a little bit. And I'm going to tune out, produce this video, get it over to the YouTube channel, and then we'll continue trading the rest of the day. God bless. Bye for now.